Are you looking to up your real estate investing game? Well, you're in the right place. Welcome to the Sub 2 Deals Show with your host, Sub 2 expert William Tingle.
Hey, Sub-Tours, this is William Tingle of Sub2Deals.com. I'd like to welcome you to this episode of the Sub2 Deals Show, where we talk about all things subject to. And occasionally we'll talk about some other stuff, or some other real estate topics, but it's always something to help you with your real estate investing business. Today we have our friend Bill Walston back. Bill's been here several times. He is real estate investor extraordinaire, experienced in a lot of different ways and just a wealth of knowledge and things that you can do to help your real estate business. Today we're going to talk about taxes. Investors love to talk about taxes. I know I certainly do. I try to stay awake for that. But anyway, Bill needs no introduction, but in case you're listening for the first time, or you're one of the few people that hasn't heard of Bill or who he is or what he does, we're just going to let him tell us a little bit about that. Bill, welcome back to the show. Glad to have
Thanks,
you.
buddy. I am always happy to be on a Tingle cast.
Oh, yeah, man. It's wonderful, isn't it? Tinglecast. That's great. So tell us a little bit about yourself.
Okay. I think most everybody knows that I am a real estate investor. But they may not know the other side and why I feel that I'm qualified to talk to you guys about taxes. My undergraduate degree was in accounting and finance, with a focus mostly on the accounting side. And when I graduated, I took the CPA exam, passed the first time, was in the top 5 in the state, which is something I'm very proud of. My graduate degree is in tax law. I spent some time teaching advanced tax at the graduate level. And when I first got started, I had my own accounting practice, and I dealt with real estate investors and real estate agents mostly with entity and tax strategy. And after I sold my practice and went into real estate investing because I saw the profits were on the other side of the desk, I thought that I wouldn't be doing a whole lot in taxes, since I left that, but I really enjoy it. And most of my clients were, insistent that I stay focused with them on some things. So I got rid of the tax prep stuff where I don't do the paperwork anymore, but I still focus a lot on tax strategy and entity strategy.
Mm-hmm.
So that's where I spend my time. I love this stuff, which is probably a good thing because it puts a lot of other people to sleep, and somebody's got to do this so that we can help you guys, right?
I'm telling you, man, it's all I can do to stay awake. I just,
I'll try not to bore you.
Okay? Absolutely. You're not boring. It's just, it's a necessary part of the business, but I'm like, tell me what I need to do to accomplish these things. Okay, we got that. So you take care of it so I can buy some houses. And that's
right.
The way I like to do it. Okay.
Cool.
So what I really just wanted to talk to you about today are some of the more common questions that I get from investors. What can I do to help this or help that? So, and probably, obviously, the biggest one is what's the biggest thing that an investor can do to just lower their overall tax liability?
Okay, well, the nice thing about taxes is the tax code loves real estate investors and small businesses. Okay, and as a real estate investor, you are a little bit of both. Okay, depending on what your acquisition strategy is, what your and how you sell your properties and take your properties and stuff. The first thing, though, that I would suggest is to find a good tax preparer, somebody that you resonate with, because it's like you are, if you're investing in real estate, you don't have time to learn the tax code. That's not what you want to do. I like to make sure that my clients are what I call tax savvy, which means that they are aware of taxes and how they affect their real estate investing, but they don't have to know all the intricacies, the ins and outs, and how it works. They leave that to someone else. So that's why I say you need a good tax pro. It does not have to be a CPA. There are some very, very good tax professionals out there who are not certified public accountants. There are enrolled agents And those are folks who used to practice before the tax court, or they have taken a special exam. Maybe they worked for the IRS for a while before they started working on their own in the tax prep side, and they're called enrolled agents. There's some uh, attorneys. Okay, John Heyer is one of the best tax strategies that I know of, and he's an attorney. He's also a CPA, so that's an advantage for him. So there are a lot of good people out there who are not just certified public accountants. So you don't necessarily have to be looking and saying, "Oh, I've got to have a CPA." That said, if a CPA is signing your tax return, that does add some credibility to it. Okay. Uh, but as an investor, let's talk about some specific tax strategies for real estate investors. All right. And I'm talking about the investing side. And you know as well as I, there are some people who are in the real estate arena, they're not considered investors. Okay.
Yeah.
Hate to tell these wholesalers, but they are not investors. And we'll
Right.
talk about that a little bit later. But these are strategies that are specific to real estate investors. And the first one I would say, if you're going to be holding real estate, and remember, if you are investing in real estate, you're buying it and holding it most frequently for either appreciation or for rental profits or something like that. And one of the best ways to buy them is in a self-directed IRA, okay, either a Roth IRA or just a regular IRA. Okay, so that's going to give you tax advantages because all the income earned in those IRAs are not going to be taxable
Right.
until you start taking distributions. And if you do it in a Roth, they're not going to be taxable at all. Even the
Oh,
distributions are not going to be taxed.
yeah.
Okay,
That's Roth's pretty awesome.
Roths are great. And what a lot of people don't realize is that you can take a property, a sub 2 deal,
Mhm.
into a Roth if you're going to hold that property as a rental property. Right? A lot of people
Okay.
don't know that you can do that because they think, oh well, it's got debt on it. And if you try to put a property into an IRA that has debt on it, you've got to make sure that that uh, debt is non-recourse. Okay, and
Mhm.
basically that means that the property has to stand for the debt itself, and you can't be sued if the debt's not paid or something like that. And we know
Yeah.
that's how sub two deals are.
Well, yeah. Subject two is perfect for that.
Absolutely perfect for that because we're not on the debt,
Yeah. That's
right?
right.
So it is non-recourse to us as the holder of the IRA. So we can throw those puppies into an IRA account and move on down the road.
Mhm.
Okay, so I love the idea of investing with a Roth IRA or just a regular IRA. The other thing that you can do as an investor is to hold your property longer than a year. Okay,
Okay.
because that makes it a long-term capital gain, a long-term
Right.
capital asset. So if you sell it after a year of holding it, okay, then the gains are going to be long-term gains.
Mhm.
And some of those long-term capital gains, depending on what your tax bracket is, may not be taxable at all. Okay, that's one thing that the um, TCJA, the Tax Cut and Jobs Act of 2017, it eliminated the taxes on a certain level of capital gains,
Mhm.
right? Depending on what your income bracket is.
Before
Okay.
I started just selling with owner financing, that was my game. I would initially sell them on a lease option, or, well, I shouldn't say sell on a lease option. That's not what we're doing,
Right.
but you know what I'm talking about.
Yes,
So,
I know exactly
we
what
would
you're talking about.
put some, put someone in on a lease in option for at least a year,
Hmm.
and then either try to convert them over or sell it after that time.
Right. And that's been a strategy. I still do that strategy with some of my properties, and
Mhm.
which you know that we've talked about before, whether we do still do lease and option deals or not.
Right.
I don't necessarily acquire properties using lease and option deals.
Mhm.
I go sub two or with a wrap mortgage or something like that. But I don't mind disposing of the property with a lease and option transaction because it will extend the idea of the capital gain, right? So I let them exercise the option after a year, and I just finance it when they
Mhm.
get ready to exercise it. So I get the combination of both worlds. Some people just don't want to deal with the fact that you are a landlord for a year, essentially. right?
Yeah, that's
But
why I got out of it.
right, but depending on how you train those tenants, right? You don't have a whole lot of problems with it. I don't anyway, because I tell my folks, say, hey, you know, you don't call the bank in the middle of the night if you got a leaky faucet. So I don't expect you to be calling Bill. All right. You're responsible. You are homeowners in training, and
Mhm,
you are responsible for minor repairs and maintenance.
mhm.
And most every state that I've worked in, you can transfer those minor repairs and maintenance to the tenant, right? You can't transfer large repairs like, furnace
Right,
or roof repair or something like that. But you wouldn't anyway. You'd have to fix those items if you're going to sell them, if you sell the property.
right.
So I will do that because, and another thing that it will do, we'll talk about this a little bit later probably because I've seen some of the questions that you were bringing to mind. Uh, it will also establish the fact that you were holding the property for a rental property,
Mhm.
right? And it helps eliminate some of the attributes of dealer property,
Yeah,
right?
that's right.
So that's one of the things that you can worry about. All right.
Mhm,
The other thing that you want to do as an investor, okay, is to make sure that you uh, don't fall into that dealer category, right? Because if you do, you're going to end up paying self-employment tax. So you want to uh, get away from that. You want to have an investment intent. The other thing that some people do, and I've counseled some of my clients have used this strategy. They'll live in the property for a couple of years before they sell it.
mhm. Well,
Okay.
if you're buying in any volume, you can't do that. That's
Well,
all.
that's true, but you
Yeah,
can do it on some of them, and
yeah.
because here's where that fits. A lot of times somebody will buy a property and they want to do some repair on it. They want to do some reno on it, right? They'll move into the thing. Now, not everybody do that, right?
That's right.
Not every family's going to do that. Not every wife is going to let you do that,
Oh,
right? They don't
that's
want to
right.
move into a property that's being renovated, but it also depends on what it is. Or you may see a property that you like, but you might not want to stay there every year. I've got a buddy who graduated from college. He started doing this, right? And for I think it's like 10 or 15 years, he moved every couple of years,
Mhm.
right? And the reason he did that is because of the capital gains exclusion on a primary residence,
Mhm.
right? He could sell those suckers and make up to $250,000 and not have to pay taxes on it.
Yeah, I've always thought of that as sort of a single guy's game to
Yeah, it could
buy.
be.
Yeah,
Yep. Because I did notice that once he got married, he slowed down on the moving aspect,
I'm sure he did.
right? And actually, there's no there's no specified number of times that you can do this under the code, right? It doesn't say, hey, you can only do it on 2 houses, or you can only do it every couple of years, right? Or every 10 years, or what have you. You could conceivably move every 2 years
Mhm.
and exclude the capital gain.
Right.
Another thing that we as investors can do is defer taxes with a 1031 exchange. 1031 exchanges are awesome, right? Basically, what you do is when you sell a property, you trade up, basically. And a
Mhm.
lot of people will do this. One of the reasons that some investors will sell a property is turn around and buy another property,
Right.
right? If you do that under what is called a 1031 exchange, then you don't have to pay any taxes on the gain on that first property, right?
Right.
So we can use a 1031 exchange. We can do installment sales. You love those just like I do,
Mhm. Oh
right?
yeah.
If you sell your property on an installment sale, the gain is taxable, but you spread that gain over the life of the contract, right? Over the life of the loan or the land contract, if that's what you're using for your installment sale. Okay, so
Again,
basically what you're doing is spreading that gain out,
unless you get tagged with that dealer thing.
unless you get tagged with that dealer thing. You're absolutely right. Um, and what, excuse me, so what you would do with that is you would spread the gain out. Let's say you have a contract for 30 years, right? You would spread
Mhm.
the gain out over 30 years. But if they pay the contract off early, what would happen then is the remaining balance of that gain would be taxable in the year the contract is paid off,
Right.
if that makes sense. So you can only
Okay.
spread it out, as long as the contract lasts. Okay. The other thing that you would want to do as an investor is to maximize your deductions. And by those deductions, I'm talking about the mortgage interest. These are things that you can take advantage of, right? Mortgage interest, insurance, property taxes, maintenance on your properties, property management fees, advertising expenses. Um, those are the normal ones that you would have as a real estate investor. Okay. But some that you don't think about sometimes is software. Like
Mhm.
if you're using PropStream or some of those other types of software, you can deduct all of that. Cell phone costs, you can deduct that. Travel, you can deduct that. Okay. If you're having to go from one property to another, and here's one thing that I will do. Some people laugh. They says, "How do you choose your target market?" I said, "Well, I usually pick a place that I have friends, family, or places I want to visit."
That's right.
Okay. For the simple reason, I go and check on my property. So if I go to Eastern North Carolina to visit my daughters, okay, then I will always call my property manager ahead of time, okay, and schedule some time for us while we're there for meetings to check on my properties that I have in Greenville and to look at new properties. And that makes my travel there deductible.
Oh, and your expenses while you're there too.
And the expenses. Now, I have to be careful with that a tad, right?
Mhm.
Because what they say is if your travel there is not 100% business, okay, you have to allocate
Well, still,
between business and personal.
yeah,
However, right, my trip there, like the drive time there and the expenses on the road while I'm going there, that's 100% deductible.
mhm.
Okay, the day that I conduct business, eating or whatever, 100% deductible.
And
Right, the drive back,
that's the day you
100%
go to the
deductible.
nice restaurant.
Right, the day back is 100% deductible.
Yeah.
Okay, because I would have to get there whether I visited anyone or not. Now,
Mhm.
the time that I spend with the family, okay, if I have expenses on those days, those expenses are not deductible. But that's not going to be very much, quite
Right.
honestly, because we're not going out all the time and stuff like that. What I'm saying is that the bulk of that travel time would be deductible,
Exactly.
right? You can get home office expenses. Okay, you can get the pass-through deduction, and I'll talk about that a little bit more, but these are all different types of expenses. The thing that I tell my clients is look at what you're paying for, right? Look at the items that you pay for on a regular basis, and then ask yourself, how can I use these in my business?
Mhm.
Because if you can use them in business and if you can make them business related, right, then they're deductible.
Exactly.
All right. But you've got to have a legitimate business purpose. You can't make stuff up. Okay.
Yeah, that's
But you
right.
got to have a business purpose. I can deduct my cable bill for a couple of reasons. It's connected with my internet service, right? And
Mhm.
I'm one of those crazy people who watch a lot of um, the the real estate related TV programs,
Right.
and you can actually learn some crazy stuff from that,
What
right?
not to do.
Right, but it doesn't matter. All right, it's still going to be deductible because I can newspaper. Okay, I would almost say that your newspaper subscription, for those people who still actually subscribe to a physical newspaper, right, might be
Right.
deductible. So
Well,
always ask yourself, is this deductible? Right? How can I make it deductible? It's not, and I tell people when they're talking to their tax preparer, their question shouldn't be, can I deduct that?
it's how can I deduct that?
It's how can I deduct that? For example, think of it this way, right? Can you deduct a trip to the grocery store?
Well, I guess maybe if your corporation has some kind of commissary benefits, you could deduct part of it.
Yeah, but what if you don't have a corporation?
Well, I don't know. You tell me.
All right. Let's suppose that you're one of those people who really believe in direct mail, right?
Mhm.
You love direct mail, and you've got to go to the post office and drop off your direct mail. Is that deductible?
Well, sure it is.
Okay. What happens if the grocery store happens to be in a direct line between you and the post office?
Then the trip to the grocery store is covered.
Yep. Perfectly legitimate
Seems to
because
me,
your trip is to the post office, not to the grocery store. But there's nothing that says that you can't stop off on the way because you're not deducting time, you're deducting the travel expense, the mileage.
it seems to me that, the term creative real estate encompasses a lot of things,
Oh, it
including
does.
tax planning.
It does. But people laugh at that. But I will tell you that that would pass an audit.
Well, I mean,
Ask me how I know this.
yeah, well, it adds up. I mean, what is the deduction now for mileage? Like 59 cents a mile?
59 cents a mile.
Yeah, I mean, it
Yep.
adds up.
And people ought to be keeping up with that. One thing they ought to be doing is taking a picture of their odometer every January 1st
Hmm.
to prove or to write it down somewhere what their beginning mileage was. They need to keep up with the mileage in some type of mileage book. There are apps for that now,
Right.
and people ought to be tracking that because you lose deductions if you can't prove your mileage,
I know.
right?
I
So it's
always,
crazy not to do that.
when I was local, I just carried one of those month by month calendars, the small ones you put in your pocket, and I just had it in a glove compartment. And I take it out every day and write the miles down, and
Yep.
that's it.
Okay. And one thing this year that's new, okay, from just based on the passage of the um, Tax Cuts and Jobs Act is the 20% pass-through deduction, and I'm sure you've probably heard of that, right?
Mhm.
Okay. And basically, in a nutshell, it says that if you have pass-through income, like from a Schedule C, from a from a partnership, from a S corporation, those types of business entities, okay, there is a 20% deduction on that income. Okay, now that's very simplified because the IRS is not going to make it easy. There are some formulas that you have to go through to find out how much is deductible and what income it can be applied to. But the basic thing that you need to keep in mind is that if you have pass-through income, you might have up to a 20% deduction on that income. It's called qualified business income. And rentals are included, right?
Right.
Rentals are included, and that was a big question for a long time. And people went round and round with the IRS about whether or not rental income is going to be included as qualified business income because on one hand we don't want it to be considered business income because that would make it subject to self-employment tax, right?
Right.
Because it's passive.
Hmm.
But we didn't want to miss out on that 20%.
Yeah.
Okay. So what the IRS has finally done, and it's just been a few months ago that they came out with the final rules and regs, and they have just said that rental income is considered qualified business income as far as the 20% pass through is concerned.
Well, great.
And that does not make it subject um, to self-employment tax. Okay.
Yeah.
Um, so if you are making no more than $315,000 for married couples or $157,000 for single, okay, there's no qualifications. It's a flat 20%. And then if you make more than that, it starts phasing out,
Hmm.
right? But that would apply to all your different types of income. So if you have a S corporation that's a consulting firm, and then you have rental properties, and then you have a partnership that you're in, all of that would be combined and subject to the 20%. But
Hmm.
that's pretty hefty.
Yeah.
Okay. All right. Let's see if there's another one. Well, depreciation. Oh, the other one was die owning your properties.
Yeah, that's right. That's the way to get out of the tax.
Did you know that will basically escape the tax
That's
that you
right.
would pay? Because if you don't, what can I say? People laugh about that, but believe it or not, that is one way for the property to escape the big tax, right? Because
Okay.
one of the biggest things that we worry about as investors, maybe we don't worry about it because, but older investors probably did, because they would buy properties and hold them for 20, 25, 30 years,
Mhm.
right? Well, what happened to those properties? If you hold a property for 25 years,
You pay it off.
well, you pay it off, but not only that, don't you think it probably appreciates in value,
Oh, absolutely. Yeah.
right? So you might have bought a property that you paid $150,000 for it. Now it's worth $900,000.
Hmm.
Okay, you got $750,000 of capital gain.
Well, and then you've got depreciation. You don't have to recapture either.
Well, right. But the thing is the biggest gain, the cost
So,
minus, right, is
yeah,
the 750,000.
right.
And that $750,000 gain would be split up between depreciation, recapture, and just capital gain. But the
Hmm.
point of the fact is you got $750,000 you got to worry about. Right? If you
Hmm.
died owning that property, did you know when your estate got that property, they would value that property at $900,000?
Well, yeah, they get the stepped up
They get
appreciation.
what's called stepped up basis.
Yeah, right.
Okay, so that's a thing that we enjoy as a real estate investor. The
Yeah.
the biggest thing that I could say about how real estate investors are going to reduce their taxes is you got to know the rules of the game,
Hmm.
right? Taxes are a game, just like anything else. You got to know the rules and then play by the rules.
Well, let me just be more specific here for just a second. For those of us who, like for me, for example, I buy a house, I sell it. That's my thing. That's what I do. I'm not interested in rental property. And let's just say that for the people out there that are listening, and that's what they do, they
Hmm.
sell it with owner financing, installment sales. What would you, I mean, just off the top of your head, the quickest thing they can do to lower their tax liability? What steps should they take to do that?
All right, so you are just buying the property for sale,
Yeah, your
right?
your
With
intent
the
is obviously to resell it. I mean,
okay,
yeah,
well, that's the problem. What you just said, okay? Because basically, if your intent is to buy the property and your intent is to resell it, you're a dealer.
but well, we're
Okay,
not a dealer until
so
we're called one.
so what you want to do is make sure that you are not classified as a dealer. And quite honestly, that's one of the biggest things, because in the real estate business, we have real estate dealers and we have real estate investors.
Hmm.
Okay, so the biggest thing that you can do to decrease your tax liability is make sure that you are not classified as a dealer.
Yeah. Okay.
Honestly, that's the biggest thing.
Yeah.
Okay,
And
is to make sure that you
and
are not
and
classified
in
as a
all
dealer.
honesty, I mean, for me, and you tell me if what your view is on it. I'm not a dealer until I'm called one.
I would not disagree with that.
Okay.
It's what your intent is.
Yeah. Well, yeah, I mean, you don't, I guess, have to announce your intent, but when someone looks
Right.
at your over what you've been doing
Well,
for the last several
yeah,
years,
I
they kind
well,
of,
I will tell you, buddy, sometimes people do announce their intent,
yeah,
and it's crazy. I don't see why they do that.
yeah.
Okay.
Well, I mean, like for me, I guess if I were talking to the IRS agent, my story would be that, listen, I buy these houses and I'd love to lease option them or whatever, but I can never find anybody that's interested in that, and that's just the way it is. So, but at any rate, so what you're saying is, we go in, we buy these houses, we sell them on a land contract or with some kind of financing, and just take installment sale deductions until we're classified a dealer if that
Yep.
happens.
Right.
And if you're not audited, then there's no problem there.
Well,
But
you know what? It depends on how risk adverse you are. Okay.
yeah,
Because I mean, I'm going to lay it out there. There are some people, okay, who would look at your model and they would say immediately, and tax preparers, I mean, I'm talking about tax preparers now, they would immediately try to classify you as a dealer.
Well, yeah, but
just based on what you do.
that wouldn't be the person working for me, though.
That's exactly right. I'd be looking for another tax preparer.
That's right.
Okay. Because at the end of the day, you are the one that is responsible for your taxes,
Hmm.
not your tax preparer. And a lot of people don't understand that. Okay. But let's say that a tax preparer screws up and you owe taxes and interest and stuff like that. Do you think you can't look at your tax preparer and say you're responsible for this? Okay.
Right.
Now, depending on what the level of profession and licensure that preparer holds, that might have something to do with it. But as far as Internal Revenue Service is concerned, you're responsible for the tax return.
Right. I mean, they're not going to look to them because they made a mistake
Right.
or whatever.
Right.
Yeah.
Exactly.
Yeah. But I mean, you agree with me. I mean, the person that handles your taxes for you should, I mean, avoid, I'm not talking about asking them to do something that's obviously illegal to do. But,
Correct.
as far as how you want to file certain things or whatever, I mean, they should follow your direction.
Right. And if they don't, you find somebody else.
That's right. Just like the attorneys that we talk about that, want to do all kind of different weird things when they close a sub two. If they won't do it the way you want it done, you need to get a new one.
Right. That's what I would say.
The Sub 2 Deals Show with your host, Sub 2 expert William Tingle. We'll be right back. Hey Sub-Tours, have you been trying to learn how to invest in real estate? It can take you years to learn the ropes on your own. How many people do you know who have been looking into real estate investing for years, but have never bought a single house? Do you have shelves full of courses but lack the courage to get out there and close on that first deal? Are you tired of so-called coaches who always seem to have just one more thing to sell you that you absolutely must have to be successful? Are you tired of trying to piece it all together with YouTube videos and free forms found on the internet? Is that really any way to build a business? William Tingle has been coaching real estate investors all over the country for over 16 years. And if you are ready, he can show you how to buy all the houses you want, anywhere you want, without ever having to ask a banker for one thin dime. Contact William today at sub2deals.com and schedule your free 30-minute strategy session. Talk it over, and if you think you're finally ready for success, he'll get you going. Back to the show, the Sub 2 Deals Show, with your host, Sub 2 expert William Tingle.
What is the best way for an investor to go out and just find a tax person? What would you recommend? If I'm new and I'm getting started. Now, listen, my first experience, I took my first 4 properties that I bought. I took those files right into the H&R Block, and that didn't go well. So how should there was a process after that, but
Right.
so
What I would suggest is talk to a few tax preparers, what I call tax pros.
Mm-hmm.
Okay. Find out what type of clients they have. Ask them if they work with real estate investors. Specifically ask that question. Say, do you work with real estate investors? Okay. Do you know the difference between a dealer and an investor?
That's right.
You can get very, very specific about the questions that you ask once you find somebody to talk to. The other thing to do is ask people, who they use, who would they recommend, right? A lot of times referral is the best way, because if you can ask at a RIA meeting, say, who do you guys use for tax prep? Right? Who do you guys use to close your sub 2 deals? Who do you guys use for such and such? Right? Other investors will know,
Mm-hmm.
and they will probably tell you. Sometimes they won't. They want to keep them to themselves.
Yeah, that's right.
But a lot of times they'll share. All right. So I have a few people that I recommend for tax prep, right? To put the numbers on the form. Okay, I have a few people that I recommend. If anybody wants a referral, they can hit me up with a private message, and I'll be glad to give some names. Tax strategy. There are different people who just do tax strategy. I do tax strategy. John Heyer does tax strategy. Trying to think who the other person. Jeff Watson will sometimes do tax strategy, although he's more of IRA, 401k stuff. But there are a lot of people out there. You just talk to them.
Yeah. Okay. All righty. Well, listen, the next question we got here is, what business structure Well, let me expense the absolute most I can to pay the least tax.
Okay.
You
So
see
there's
a
a,
theme
you know
here.
what? I love these hypotheticals. All right.
Everybody
And
wants to pay the least tax.
I know they do, right? And you know what? Judge Leonard Hand said that's absolutely okay. Says every person has the right to arrange their affairs, okay, so that they pay the least tax possible,
I agree.
right? And that's it, you know, and I agree with that. So we all want that. Okay. Now the standard answer for a hypothetical like this would be it depends.
Yep, that's right.
Okay. But let me say this, all business structures allow for business expenses. Okay. If you've got a true business, a, a legitimate business expense, okay, then any business structure that you choose is going to let you, sub, you know, write that off,
Mhm.
expense it off. Okay. That said, there are some business structures that are better than other business structures. Okay. For one thing, as a real estate investor or even a small business person, I would stay the heck away from a Schedule C.
Mhm.
Do not do business as a sole proprietorship. That
Right.
is the worst business structure that there is out there. Okay, not only from a liability standpoint, but from a tax standpoint, did you know that Schedule C is the most highly audited business structure?
Right.
Okay, so I would do something else. The rule of thumb, okay, the rough rule of thumb, and you'll hear everybody say this, but they don't always go in and explain exactly why or whether it applies to you. But for most people, okay, you use an S Corp for flips or wholesales or what we call earned income, or an LLC taxed as an S Corp, okay, and a partnership for holds. Have you heard that before?
Not about the partnership, no.
Okay. You don't want to hold, yeah, I don't like to have uh, inventory investment properties that I'm holding, okay,
Mhm.
to go on my personal tax return if I can help it.
Right.
All right. So the only way you can keep that from happening is to hold them in a partnership because you don't, that's passive income.
Right.
Okay. So you don't want it in a S corporation
Well,
because you don't ever want to hold rental property in a corporate
yeah,
entity.
you can't get anything out of a corporation hardly.
Right. So that would throw out the S corp. The only other way to keep it from going on to your personal tax return is to have it held in a partnership.
Yeah.
Now, does that mean you have to have 100 partners? No. Okay. All you have to do is have a multi-member LLC, and that's automatically taxed as a partnership.
Mhm.
All right. And that other member can be another LLC,
Right.
can be a 5% member or something, right? Or as some people do it, they will form a C corp, a regular corporation, to be a 5% partner in all their LLCs. And it just sits there and doesn't do anything else.
Right.
So that's an idea. All right, but that's the general rule of thumb
Mhm.
for real estate people is if you are flipping properties, if you're a rehabber, anything like that, you want property management, believe it or not, and all you're getting is fees from property management, right? Those types of things would be S Corp. And then any properties that you buy and hold are going to be um, a partnership.
Right. Okay. Well, listen, I want to go back to this dealer thing for a minute because,
Okay.
obviously I haven't
And I thought you
answered
would.
that. But so and I think I know the answer to this already. The best way to avoid being classified a dealer, well, number one is don't get audited.
Yeah,
Number two would be to hold a couple of rental properties at least, so you had some kind of argument,
right.
I'm guessing. But let's say the worst thing happens, you get audited, you're classified a dealer. Now, I know there's got to be a way to do something else really quickly so that the properties you buy going forward, you can still do the installment thing. So why don't you tell us about that?
Okay, well, the one thing that you want to do is understand the difference between a dealer and an investor. all right? Because you want to go ahead and start laying the groundwork in case of a potential audit,
Oh
right?
yeah.
To document the fact that you are an investor and not a dealer. Now, I hate to tell people this, but if you're a wholesaler, okay, or you're a rehabber, you can pretty much hang it up
Oh yeah.
because that clearly fits the definition of a dealer, okay? And you should be using an S corporation or a LLC taxed as an S corporation for the simple reason that pass through is not subject to the self-employment tax like it would be if it came through on a Schedule C.
Okay.
Okay. Um, the problem with the S corporation is that they do require that there be a reasonable salary,
Hmm.
right? But there are ways to adjust that. I have clients who are in their first couple of years and they haven't even declared a reasonable salary yet, and there has not been a problem.
Right.
And none of the pass through is subject to the self-employment tax. But I'll tell you, if most accountants, if they tag you as a dealer, they're going to try to put your flips and contract assignments and stuff like that. They're going to try to report it on a Schedule C, and that is the worst possible thing that can happen.
Yeah.
All right. So what you want to do is go ahead and start laying that documentation. Now, a dealer is classified as being in the business of buying property with the primary intent to resell it. And it doesn't make any difference if you're a rehabber, doesn't make any difference if you are a flipper, doesn't make any difference if you are a so-called wholesaler that really is doing nothing but assigning contracts. Okay,
You're buying it and selling it.
you're buying it and selling it. You're a dealer. All right. Now, what a lot of people don't realize is, all right. So, William, you and I started out with lease options, but we probably started out with lease what we call sandwich lease options, right?
Oh, yeah, I did a
To
few of
some
those.
degree, if you
Yeah.
did a few of them, right?
Yeah.
Okay. And I'm sure all of you have heard wholesaling lease options, which is really nothing but a lease option assignment. Okay.
Hmm.
Did you know that is also considered flipping?
Well, of course it is. I
Okay.
mean,
Oh, I had somebody argued with me, wanted to argue like for a long time, right?
listen.
That
I
that
mean,
that 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 lease options didn't have anything to do with flipping property. Okay.
well, yeah, I don't see how they could think anything different.
I didn't either, but some guru told them this is, oh no, this is wholesaling lease options, and it's not the same thing as flipping property.
Well, I
You
mean, you're
know,
in and out of there. You get your profit and you're going. I mean, that's the
it's
definition.
a contract assignment.
Yeah,
It is
it's
specifically a contract assignment. It is going to be subject to self-employment tax.
yeah.
So all these people who bought into the wholesaling lease options things, and I think that was a great course, but I don't think Joe reminded them that, hey, don't forget that, this makes you a dealer, okay?
Yeah.
And this income is subject to self-employment tax. But it
Right.
is. All right. So the IRS basically looks at a lot of different factors when they're trying to decide whether you're a dealer or not. They'll look at how many sales you had and how frequent they were. Like, is this something you do all the time? Is this your main business model? They will look at the original intent of when you bought the property. Um, they're going to look at different improvements, like if you're a rehabber and you're buying and rehabbing with the intent to sell. Did you know if you bought that property and it took you longer than a year to rehab it, that it would still be flipping property? It would still be dealer property.
I
So,
never
so the
considered that.
yeah, so the fact that you hold it for a long time does not mean that it's not dealer property. Okay,
I
a lot
guess
of people do. They think, oh, I can buy it and I can hold it for a year and fix it up and then automatically sell it, right? If you bought that with that intent, it's a dealer property.
well, not only that, it seems to me that it would need to generate some income in the meantime in another
Yeah,
way.
it would need to. All
Yeah.
right. Your marketing efforts and the holding period, how long you hold the property. I'll tell you, but if you hold property for less than a year, most of the time, the first look at that property, the IRS is going to try to classify it as dealer property, because investment property you usually hold for longer than a year. Okay. Now, if you have, and they'll look at your other income, right? Do you do a lot of contract assignments? And then all of a sudden you buy a property and close on it and then sell the property, right? They're going to consider that to be dealer property.
Yeah.
Okay. So, we look at it and we say, well, what difference does it make? Well, okay, the tax consequences if you're classified as a dealer is you're going to have ordinary income that is going to be subject to self-employment tax. There are no 1031 exchanges. Okay, there is no installment sales. Your income has to be reported on a Schedule C and not on a Schedule E, which automatically puts it in a higher audit bracket, right? Or makes it be looked at for audit. You don't get any type of capital gains, okay? And you can't take any depreciation on any of that property, okay? So some things that you want to look to, the differences between the dealer and the investor. A dealer will buy a lot of properties and sell them. These guys who say, oh yeah, I'm doing 20 properties a month, right? I'm not sure if I'd get out there and post that on Facebook.
Yeah, that's right.
Especially if I don't want to be considered a dealer, because that automatically almost shows their intent, okay? Properties that you buy, fix, and sell are nearly always considered dealer properties. If you begin subdividing properties, okay, or subdividing land, that's going to be dealers. And as I already said, it's held for a short period of time. Now, on the other hand, an investor, their purpose is to hold for appreciation or to produce income. Hold for appreciation or to produce income.
Right.
Okay. So, all right, that same property we were talking about, taking a year to rehab. Okay, let's say that we did that on one property, and our usual purpose was to buy property. So we had like 3 or 4 rental properties already. We bought this one, took us a year to rehab it. Okay, now it's ready to sell. If we sold that, believe it or not, we would have a good case for that being non-dealer property, because we have other rental properties. And our intent when we bought that could have been to fix it up and rent it, right? But as we all know, stuff happens, and we just decided to sell it instead because somebody came along and made us an offer.
Yep.
Okay. So that's a little bit different. Now, William, you're going to love this one. Okay. Would you believe that most of the time property held in a trust is considered investment property?
Well, you got to love that.
Would you seriously? All right. In most audits, if there's trust property being held in a trust is assumed to be investment property. Now, would the IRS maybe try to prove that it's not? Sure. Okay. But the burden of proof kind of shifts.
I guess that would depend on the auditor too, and how aggressive
that is true.
they were.
Right? That's true. All right. So, and remember I said that sometimes the way you get a property, the way you buy the property will determine whether it's going to be classified as investment or not,
right?
Which I just said, if you acquire it in a trust, if you acquire it by inheritance, okay, if you inherit a property and then you turn right around and sell it, it's not treated as dealer property.
Right.
Okay. If a trust is dissolved and you end up, because you're the beneficiary and the trust is dissolved and you end up with the property, it's usually not considered dealer property. Hint, hint. Okay. If you get a property from the foreclosure of a mortgage, right? So let's say that you are holding a mortgage on a property and you go and you get that property back, okay, because you had to foreclose on the mortgage, that would not be considered dealer property. But the big thing, and I can't stress this enough, is your intent. That is what IRS will look for. And, it's kind of hard to sometimes to prove what your intent is. You know
Yeah,
what I mean?
unless you put it out there.
Unless you document it.
Yeah.
How many times, William, have you seen a property, I'm sorry, a contract? Have you ever seen this in a contract? The buyer intends to sell this property for a profit.
Oh yeah.
Have you ever seen that in a contract?
Sure.
Yeah. You know what that makes that entire deal? Doesn't make any difference if they hold it forever. Okay. That's a dealer property
Yeah.
because
Well,
your intent was to sell it from the get-go and you documented your intent that you were going to sell it for a profit.
mhm.
Okay. So documentation is a big thing. Okay. One of the things that I tell my folks when they start an LLC, every LLC needs an operating agreement.
Oh, and that agreement should say that
That
you're
agreement should say something like this: the purposes for which this company is formed are to construct, buy, sell, trade, lease, rent, or otherwise engage in the obtaining of residential and commercial property of any kind as an investment by holding for appreciation or to lease or rent at a profit.
okay. So
That's the
everybody
purpose.
got
That
that
is the purpose of your company.
for
All right.
their operating agreement. Oh
And
yeah.
it should always be in your operating agreement. But now you can't put that in an operating agreement and then do nothing but flip properties, guys. Okay, you have to be reasonable, right? But you do need to document what your intent is, and you need to make sure that you don't ever put into a contract that you are buying that property to sell for a profit, because that will automatically classify that property as dealer property.
Okay. So let's say the worst happens. Let's say that man, I hate to even like speak this into
I started
existence.
to say, you better not speak something into existence. I don't have time for no audits.
Okay, but let's say there's an investor out there who buys properties every year and they immediately resell them on
Yep.
land contracts.
Yep.
And the worst happens and they get an audit and the IRS guy says, you're a dealer. And
Mm-hmm.
you can't claim this installment income anymore. And this is, and this just the worst. Okay, so how does this investor buy another property and claim installment income? What does he need to do? I mean, what entity does
Well,
he need to
he he
form?
he he better start. Okay, he better start documenting his intent. Okay, he might want to switch over to the thing that we talked about earlier by renting the property out for a short period of time.
Mhm.
Okay, and then selling the property, letting that option be exercised.
Right.
Okay, because that would give some rental income on the property. It's hard for Internal Revenue Service to come back and say, oh no, this you did not buy this for investment. You'd say, well, why the heck did I rent it out?
I guess what I'm getting at is being classified a dealer doesn't have to be the end of installment income.
Oh, no, 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 it does not have to, because what a lot of, and I've heard some accountants get this mixed up as well. They think that once a dealer, always a dealer.
Right. And
Okay,
that's what
that
I'm
is
talking
not
about.
true. Dealer is determined at the property level, not at the entity level. Okay, by that I mean they have to look at each individual property and say, is this dealer property or not dealer property? So you can actually be classified as a wholesaler and most of your stuff be considered dealer property, and you can buy a property and hold it for rent for a year and sell it, and that's not dealer property, it's investment property.
Okay.
Am I
So
is that clear as mud?
yeah, well, no, I mean it's just that's what you hear with most people.
Yeah.
If you're classified as a dealer, boom, it's over. But
No, it's not.
that's not really the
No,
case.
it is not. But I will say that if you are classified as a dealer, I can almost promise you that you will be looked at again.
Yeah.
Okay. Because ordinarily what happens is something like this. They would audit you for 2017 or 2018, right? And they
Mhm.
find these properties that you sold and they look at that and they say, okay, you're a dealer. And these transactions are sale of dealer property. Right. Well, they're only auditing you for the 1 year. So that year's transactions could be screwed.
Right.
Okay. Now, what they may do is say, hey, if he did it this year, he might have done it last year too. All right. So they can go back for a certain period of time and audit those returns as well and reclassify that. You could, however, argue, I mean, in an audit and say, this is why I sold them. Okay. And if you could document some intent, an investment intent, that's between you and your auditor. Okay. But I could tell you this, more likely than not, you would be looked at for a following year or so as well.
But the bottom line on it is this. The safest thing to do is, let's just say that you want to buy a dozen properties this year. You're going to buy one a month. And I just use that example. That's what I do. But so a certain percentage of them, you should try to just hold as rentals.
Mm-hmm.
And I don't guess it has to be a great number. So maybe 25% or whatever.
You need to show your intent to be an investor.
Right. Okay.
And you saw what your intent was. And anything that you can do to document the fact that you are acquiring property to hold for appreciation or to hold for some type of income, okay, then you are documenting that you're going to be an investor.
Okay. All righty. Well, I guess.
And it's a fine line, right?
Yeah.
It's a fine line.
And there's so many variables in it. Like I said, the auditor and, just how aggressive they are. And
right.
I guess just your likability. I mean, there are a lot of factors there. I've talked to several people who are in similar situations that I am that say they got audited and dealer was never mentioned.
Right. Yeah, that's what I'm saying. It depends.
Yeah.
Right.
Okay.
And it gets back to that same thing, like that SEC attorney, a good friend of mine, said is that SEC rules and tax rules a lot of times, okay, is like driving 100 miles an hour in a 75 mile per hour zone. It's all good until you see the blue lights.
That's right.
See what I mean?
Well, yeah, that's just like, pretty much any deduction you take's okay until the auditor comes. So.
That's between you and your priest.
That's right.
You and your tax accountant.
That's exactly right. Okay. Got a guy that asked me, he said, hey, I'm operating as a sole proprietorship. How do I structure everything for maximum benefit? I know you've already said that's the absolute word.
You stop.
Yeah, you just
absolutely stop.
So what's the easiest thing he can do to switch over right
now? And when he says I'm operating as a sole proprietorship, there's really not enough there to know what you need to do, because he could be operating as a sole proprietorship and have all rental properties, or he could be operating as a sole proprietorship and be doing wholesaling. Those are two different types of income.
Yeah.
Right? And so you would have to do different things in order to structure that. Quite honestly, I would be more concerned if I was a wholesaler as a sole proprietorship than I would be if I was holding rental properties as a sole proprietorship. Because actually you don't hold rental properties as a sole proprietorship. They go on a totally different schedule. Rental properties would go on a Schedule E. But most people think, hey, if I'm doing it myself and I don't have a LLC or I don't have a corporation or I don't have a partnership, I'm a sole proprietorship. That's not really the case.
Right.
Does that make sense? Right. But if you are a wholesaler, or if you are doing wholesaling lease options, right, and you are reporting that income on a Schedule C or on your personal 1040, stop doing that. Set up some type of entity and move that income and the expenses off of your personal tax return.
Mm-hmm. Okay. So if you're operating in your own name, just stop.
Right. Truly.
Yeah.
Truly.
Yeah.
Yeah.
Okay.
Trust, LLC, beneficial interest.
Mm-hmm.
Trust, LLC, beneficial interest. Okay.
That's just the best thing to do. I mean, that's what I say all the time.
I know people get tired of hearing us say that, don't
Yeah.
they?
Well, I mean, one day they'll get it. I did. Um, I mean, the sole proprietorship thing, and a lot of times you throw that out to people that are new, that are trying to get started, that are delaying buying a house because they can't decide
Oh,
between
yeah, 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 yeah.
corporation, LLC. Well, so listen, I bought my first like 3, 4 houses, just William. I mean, William bought them. Okay.
Sure.
And I wouldn't do that today, but if I had waited until I had just the right structure, just the right entity, I may never bought a house.
You know what? This always reminds me of the client we had one time who, you know, was going through the coaching program. We were talking about things that had to get set up and how to make offers and all this kind of stuff. And we're having a phone call one day, and I'm saying, "All right, how many offers have you made?" "Well, I hadn't made any." "Well, okay, this is going on like 5 weeks now, and you've not made an offer yet. What's the problem?" "Well, I can't decide what to name my LLC."
Yeah, that's
Okay.
tough there.
So you need to take action, guys. And by no means are either William or I saying you got to get all this figured out before you start investing. That's crazy. Okay. Go ahead and take action, right? Because 9 times out of 10, anything can be fixed unless you wait past December 31st.
Yeah, that's right.
Okay. So if you do proper tax planning and you meet with your accountant, let's say that I had people who come to me for tax strategy in the next couple of months. I can look at what they've done for almost the whole year, and we can fix it. Okay, there are legal ways to fix what you have done. Okay, but if you wait past the end of your tax year, which is December 31st, then it's history and it can't be fixed, and you got to report it whatever way it happened. Okay,
Mhm.
so by no means should you wait to start investing and start making offers and doing deals, because when I make my offers, I've got all these LLCs and I've got different entity structures and stuff like that. But if I'm doing a purchase and sale agreement, that offer is in my name.
Yeah.
That's why we do it and or assigns,
Mm.
right? Because then I can decide what entity I want to put it in, if I want to put it into an entity.
That's a great point. I've had to say that a dozen times, like just the last few days, to people that worry about how to write up a contract. So listen, in most of the cases that you guys are going to be doing these subject tos, what have you, if your contract is assignable, write your contract in any name you want. How you
Hmm.
actually take title at the end can be completely different. It's okay.
That's right.
And that'll give
Absolutely
you
okay.
a week or 2 weeks or a month to decide exactly how you want to do it.
Yep. Absolutely okay.
Yeah. Okay.
Yeah. So, please don't wait in order to get started.
Yeah. Buy a house today,
Yep.
preferably, if you can. Um, well, Bill, we certainly covered a lot of tax stuff. I'm really proud of myself for staying awake. But I, what I ask you, I mean, we talked about dealer status and how to minimize taxes and take the most deductions and all that stuff. And there's so many different ways investors operate. It's impossible to give an answer for all of them. But
Yeah.
if you just had just some final tips for the average investor getting started, and what you could recommend for just some absolutes that they could do, what would those be?
Talk to a good tax preparer, okay, or a tax strategist. Find out how you need to document what you're doing, okay. Talk to them about what type of income you have. Do you have earned income or do you have passive income? Right? And the main difference between the two is that self-employment tax. And guys, that's 15.3%. That's a
Yeah,
big deal. That's a lot of money.
that's off the top.
Okay. That's a lot of money.
Yeah.
And so you need to know how, if you are subject to that self-employment tax, you need to know how to minimize it, because you're not going to be able to eliminate it. A lot of people think, oh, how can I avoid blah blah blah? Yeah, you're not going to be able to. It is what it is. If you have earned income, it is subject to self-employment tax. There are ways to minimize that self-employment tax, like running it through an S corp. Okay, because those pass-throughs are not subject to, even though it's earned income, it's not subject to self-employment tax because of the way the S corporation status. Okay, and you can have, and this includes an LLC. with an S status, S election, the way it's set up, it reduces self-employment tax totally legally. Okay. So you need to isolate that income, decide what type of income you are earning, and then choose the best entity for that type of income. Does that make sense?
Yeah.
Okay.
Perfect.
Then finally, the other question I would ask is look at what you're spending your money on and ask yourself how that can be related to your business.
Okay.
In other words, some things that you pay for every day, it's a lot better to pay for it as a business expense than it is to try to pay for it personally, because business expenses are deductible. Okay. For instance, hire your kids. If you have children, put them to work.
Oh, yeah.
Okay. Because you can write off the income that you pay your children. They can make almost $12,000 a year now, and they don't pay taxes on that $12,000, but you can deduct it. Okay. So all this money that you're paying out for the kids' clothes, for them to go to parties, for them to buy their friends presents, pay them and let them buy their own clothes.
That's right.
Okay.
Yep.
Pay them and let them buy their own clothes.
My kids got paid every month.
Yep. And the nice thing, and that's totally fine for you to be able to do that, but a lot of people don't know that they can do it. Okay. I mean, both my fur kids walk around with signs that says my daddy buys houses. I love writing off those vet bills.
Oh, yeah.
I'm just kidding.
Yeah, you
Maybe.
make the little calendar, the advertising.
That's right.
calendar,
It's
and-
advertising.
Yeah.
They get paid a modeling fee.
That's right. Yeah, absolutely. Hey, Bill, I know you do some training on this stuff, don't you? I mean, where, somebody for a day or two or something like that. I mean, don't you do something you can tell everybody about so they can
For
talk to you?
entity and tax structure. Yeah.
I mean,
I counsel my clients. I work with them on setting up their entities. I work with them on tax strategy, tell them what type of deals they should do, and a lot of times it's like, how do I structure this deal? Right? Not necessarily how do I do everything, but hey, I've got this particular deal. What is the best way that I can buy this deal? What's the best tax strategy for it? And we'll talk about entity structure and stuff like that. So yeah, that's one of my services.
But I mean, you also, in addition to just one-on-one consulting, you do a couple of educational events every year, don't you?
Oh, I do. Most of those are on creative structure. Some of them I cover some tax stuff, but not all of them.
Yeah.
Right. So most of the tax and entity stuff I do. Well, let's say, I've got a building your six-figure business, right, is one of the events that I do. And we have a tax and entity session during that. Like, we go around and talk about what's the best entity structure for anybody's particular deal, the way they do their deals.
Yeah.
So we do that. But most of the tax, the tax strategies and stuff, those are usually like on a consulting thing, one-on-one.
Right. Well, how would they get in touch with you if they want to talk to you about that?
Facebook Messenger, right? Or Bill at BillWalston.com.
Okay, great.
Bill at BillWalston.com.
Thanks so much for being here today and talking about taxes. I mean, I learned some stuff. I always do. And I'm sure it was great information for everybody listening.
I appreciate it. Love to be in here.
All right, great.
Thanks, buddy.
Sub-Tours, what was that?
I said, thanks, buddy.
Oh, thank you. That's it for this episode of the Sub-2 Deal Show podcast. You can find the show notes for this episode along with a complete transcript at sub2podcast.com. If you haven't yet, join our free Facebook group. Bill's a member. He's in there contributing all the time, give you all kind of tax tips. You can find the Facebook group at sub2forum.com. And you also find lots of resources to help you grow your real estate investing business at sub2deals.com. So until next time, keep learning, keep talking to sellers, and you will buy some houses.
Thanks so much for listening to this episode of the Sub-2 Deal Show with William Tingle. If you enjoyed today's episode, please leave a review and subscribe. And for more great content and to stay up to date, visit sub2deals.com and on Facebook at Sub2 Deals. We'll catch you next time.